Today, we are going through a case study of a couple retiring at age 60 and 62 and answering their burning retirement questions. Those questions being, what is the best withdrawal strategy for us? When should we claim Social Security benefits? How can we minimize the amount of taxes we're paying? And how are we going to pay for health insurance on the health insurance marketplace? Those premiums can be quite lofty, and so we're going to talk about strategies to minimize that. Now, to actually dive into the case study here, we are looking at Frank and Monica's situation. Now, Frank and Monica are married. Frank is age 62. Monica is age 60. They actually retired about 12 months ago, and they're loving every minute of it, but they're concerned that they might not be managing everything to the best they possibly could, and they're also concerned because their COBRA coverage is actually about to run out, and we need to then think about getting onto the health insurance marketplace or even evaluating private health insurance coverage. Now, Frank, while he is eligible to start claiming Social Security benefits because he's 62, he has not yet started those because he wants to evaluate the strategies available to him for claiming benefits. Now, they've also paid off their home. Being debt-free was very, very important to them, and so congratulations to Frank and Monica for being debt-free. They have a spending goal of $10,000 per month. That's, again, getting them entirely everything that they would want in their retirement lifestyle, and it's an after-tax number, which we have to keep in mind when we're thinking about our planning and our withdrawal strategy. To get to that $10,000 a month, they have saved $2.8 million in their nest egg for retirement. That's broken down in the following. We have $1 million in Frank's IRA. We have $200,000 in his Roth IRA. And so keep in mind that IRA money is all traditional IRA. It's pre-tax money. We're going to have to pay taxes when it comes out of the account. That's going to be really important for us to manage and think about as we come up with their withdrawal plan and tax strategy. Monica has $120,000 in her pre-tax IRA and $180,000 in her Roth IRA. They did a great job getting a lot of money into qualified accounts like their IRAs and Roth IRAs, but they also did a great job saving a lot into their brokerage account where they have $1.3 million saved. That brings their liquid net worth to $2.8 million. This is going to be the liquid portfolio that we're going to use to create a withdrawal strategy for Frank and Monica. Then we have our home equity as a separate line item here. It's again paid off, so their home is valued at $700,000, brings their total net worth to $3.5 million. And so congratulations to Frank and Monica. It takes a lifetime of hard work and discipline to accumulate a $3.5 million net worth. Looking to cash flow now, we only have two sources of cash flow here in retirement. We have our Social Security income, and we have our portfolio withdrawals. And how much we're withdrawing from our portfolio will be dictated essentially by when we're going to claim Social Security. And so we have estimates here for three of the most important ages related to Social Security. 62, when we could start claiming benefits. 67, when we are our full retirement age. And age 70, which is the latest we can defer Social Security to and get an increased benefit. Now, these estimates here have taken into consideration that they are no longer contributing to the program. And so we're looking for total cash flow at around $10,000 to $12,000 a month because we're spending $10,000 a month to enjoy and fund our lifestyle. And we're going to probably need around $2,000 a month or so to pay taxes depending on the strategies we implement. Ideally, we're going to be much, much lower. Let's take a quick look at how their investments are allocated before we start diving into more of the planning strategies. Now, if we look at their traditional IRAs, they're in a 60-40 allocation, and they're both actually invested in target retirement funds. Nothing inherently wrong with target retirement funds, especially as we're accumulating. One of the things that I think about, though, in this decumulation phase when we are spending and withdrawing money in retirement is that the target retirement fund does not allow us to pick and choose which asset class gets bought and sold and when. And so we might want to think about being just a little bit more intentional about separating the various asset classes so we have more control in our withdrawal strategy. Their IRAs are allocated 40% towards growth-oriented capital appreciation investments, 60% towards our conservative investments. But I really want to draw your attention to how the brokerage account is allocated here. They're 50% growth-oriented using mutual funds. They're also 50% conservative using CDs. Now, I don't necessarily have anything against mutual funds or anything against CDs. Both great potential tools for investments. However, in a brokerage account, what this says to me is that we're not thinking about the tax implications of using those investment vehicles. And we're going to talk about how we are going to mitigate that or manage that when we get to the tax strategy section of this video. Then let's look at their current tax return. We should always be reviewing our tax returns and going through these line by line and making sure that these numbers make sense. And is there any way that we can save more in taxes? So to go through this, top line in their income, we're seeing $32,500 in interest. This is coming from the roughly $650,000 of CDs that they have in their brokerage account. That $32,000 is being taxed at their ordinary income tax bracket, which is going to be important for us to keep in mind when we think about strategy later. They also are receiving dividends from the mutual funds they're invested in that brokerage account. $16,000 total in dividends, only $8,000 of them qualifying for long-term capital gains tax rates. And so again, we're going to talk more about that in a moment. They've been living essentially on the interest from their CDs, and they've been pulling out the difference for spending from traditional IRA money. So we're seeing about $90,000 in IRA withdrawals here. Again, all taxable at ordinary income tax rates. If you look at line 7 here, line 7 is a capital gain. Now, this capital gain didn't come from selling mutual funds and taking that money out of the account and spending it for retirement. This $13,000, if we looked deeper into the source documents, into those 1099s and account statements, we would see that this $13,000 came as a capital gain distribution. So this is actually the tax inefficiency of the mutual fund vehicle in the brokerage account, where whether the fund performance was up for the year, down for the year, or sideways, all of the internal trades that mutual fund makes creates a capital gain. And at the end of the year, they distribute that tax liability essentially to the shareholders. And so Frank and Monica had to pay tax on $13,000 worth of capital gains generated from the internal trades of the fund. If we can mitigate that and keep that $13,000 a year off the tax return, that would lead to tax savings for Frank and Monica. And so we're going to look at how we do that. That gives us a total income of $151,750. This is a super, super important number because this roughly $150,000 number is going to be what is used to calculate how much their health insurance marketplace premiums are going to be. And so we need to learn how to manage this number so that we can keep our health insurance premiums low pre-Medicare. Now, when we subtract out our roughly $30,000 standard deduction, we have about $122,000 in taxable income. When we run the numbers on the tax table, and you'd see this is on page 2 of the 1040, is that this is actually leading them to pay about $15,000 a year in taxes. So now that we've gotten an overview of their situation, we're going to look at some of the potential solutions and strategies available to them, and we're going to actually see what that looks like when implemented on the tax return. So later on, we're going to show you an exact or a projection of what their tax return might look like after implementing these strategies. Now, in terms of retirement income, because income is the most important piece of our retirement, let's talk about Social Security first. In this case, based on the estimates we looked at before, it might make sense to start taking Monica's benefit as soon as age 62. We're going to start collecting that roughly $800 a month, and we're going to defer Frank's benefit to age 70. This is going to allow Frank to collect the highest amount possible based on his earnings, which would be roughly $4,000 a month. And then once Frank turns on his Social Security benefit, we would have the option for Monica to take either the higher of her current benefit or one half of Frank's full retirement age benefit. And if we look back at those estimates, his full retirement age benefit was roughly $3,300. If we take half of that, it's roughly $1,600. Now, what's really, really important to think about is that, one, Monica wouldn't get the full $1,650 from being one half of Frank's full retirement benefit. It would actually be a little bit less because she started claiming early at 62, but it would still be higher than her $800 a month benefit today. And so this kind of strategy, where we could start one early, defer one later, and then switch in the middle, actually gives us the potential to possibly get more money out of the program, again, depending on how long both Frank and Monica live. Now, depending on, again, the Social Security strategy we go with, that'll dictate how much money has to come out of their retirement account. And so I like using a dynamic spending strategy where we're saying that our $2.8 million liquid portfolio could generate roughly a $12,600 per month in income. That's pre-tax. Now, we only need to spend $10,000 a month in the earlier years of retirement where we don't have any Social Security income coming in. Depending again on how we want to manage our tax strategy, we may need a little bit extra to come out to pay for taxes. But we're looking then again, if we think about our total cash flow and when we're starting Social Security, how much Social Security we have and our spending need, this is going to change over retirement. We may only need $6,000 a month in some years when Social Security is fully turned on, or we might need $12,000 plus in earlier years when we don't have any Social Security turned on and we're spending as much money as possible checking off those bucket list items. So I really like this flexible spending strategy where we can shift a lot of our spending earlier on in retirement when we have the time and the health and the energy to go do all the things we wanted to do while we were working. Now let's look at the tax plan here. This is going to be where the majority of value is coming in for Frank and Monica. Number one thing that we talked about wanting to do is managing our income so that we can receive the premium tax credit towards our health insurance premiums and then therefore keep the cost of insurance low before we get onto Medicare. To do that, we're going to use what's called asset location when we're talking about portfolio construction. And we're going to combine that with just tax efficient and tax smart portfolio withdrawal strategy. And then we're going to circle back to Roth conversions and why those might be important now, but especially why they'll be important later on. To dive into the asset location strategy before we see how this actually looks on the tax return, this is how we might change things. In their pre-tax IRAs, we're going to switch from that 60-40 allocation to 100% conservative. We're going to take all of our interest-producing investment vehicles like bonds, bond funds, CDs. We're going to allocate all of those into the pre-tax IRA. And the reason why is because all of the interest that's produced by those vehicles, instead of hitting the tax return and being taxed at our ordinary income tax brackets, they stay sheltered inside that qualified account. And so we are now not losing money to taxes when we hold them here. What this also does is it frees up space in our Roth IRAs for more growth-oriented investments where we're likely to see capital appreciation. Because in the Roth IRA, all of the growth and withdrawals come out tax-free. And so in this case, we really want to see a lot of growth in this tax-advantaged account. The most significant change, though, is coming in the brokerage account. In the brokerage account, we actually want to shift from that 50-50 allocation to 100% growth in this case, because what that's going to do is it's going to allow us to minimize the amount of interest hitting the tax return, which is going to free up a lot of room at these lower income tax brackets. And as you can see, these tweaks in their asset location didn't really change their total portfolio allocation all that much. They were 50-50 beforehand. They're 60-40 now. Very, very small change, but we're just being intentional about what asset class is held in which type of taxable or non-taxable account so that we can minimize taxes over the course of our retirement, but we're still expecting to see the same portfolio allocation as a total. So how does this actually look on the tax return? If we go through this line by line again, you'll see that on line 2, we've eliminated all of the interest on the tax return because we've switched from being in CDs in the brokerage account to holding our CDs in the traditional IRA. Now, in the brokerage account, we're holding more growth-oriented investments like our stocks, right, equity ETFs, and therefore we're not receiving any more taxable interest. On line 3, we're going to see that our dividends actually went up because we are holding more equity investments, more stock investments, which may produce dividends. Even here, I still want to be very intentional. I want to think about holding these equity ETFs or holding stocks that may not kick out a lot in dividends because we're keeping that money off the tax return now. But if they do kick out dividends, I want to make sure that we qualify for qualified dividends and that better tax treatment. So qualified dividends are taxed at long-term capital gains rates, which is usually going to be 0, 15, or 20%. And in this case, as you're going to see here, is actually at the 0% rate. So we're getting a really big tax advantage here by being intentional with what we're holding in the brokerage account. Now, line 7, to bring you back to capital gains, because we're no longer pulling money out of the IRAs, we're going to have to take that money from somewhere. That's going to come from those mutual funds that we had, which were more tax inefficient. and have long-term capital gains. And so if we're pulling out roughly $100,000 placing $100,000 in sales, we may create $48,000 in taxable gain, which is going to hit the tax return. But again, keep in mind that at this income level, at the married filing joint brackets, our capital gains rate is 0%. So we are really taking advantage of the tax brackets here. This leaves us with total income of $67,500. Quite the difference between the $150,000 of modified adjusted gross income we had in the previous tax return to the just under $70,000 of income we have here. This is going to be a monumental difference when it comes to calculating their health insurance premiums, which we're going to look at momentarily. If we subtract out our standard deduction, we have about $38,300 in taxable income. But again, because we're looking at making the most out of capital gain brackets, in addition to our ordinary income tax brackets, our tax at this income level with this kind of income is going to be $0. And so right off the bat, asset location is putting $15,000 a year back in Frank and Monica's pockets. That is huge savings already. They're still spending exactly the same amount of money they were before. We are just being more intentional with our tax planning. But to take this a step further, I want you to see how this actually impacts their health insurance marketplace premiums. Now, this is just pulled from a calculator online. There's dozens of them that you can use. If we think about the cost of their coverage using just a silver plan, so that's down the middle health insurance, if we're using that $150,000 number, we're actually looking at about $1,075 a month for each Frank and Monica to pay for health insurance premiums. If we go through our tax location strategy or asset location strategy, and we're more intentional with where we hold our asset classes, and we bring our income down to $67,000 a year, our cost for a silver plan is $380 a month for each Frank and Monica. That savings, or that additional premium tax credit, is over $16,000 a year. And so this one strategy alone, between the tax savings and the health insurance premium savings, is putting $30,000 a year back into Frank and Monica's pocket. That is why our tax planning is so substantial here, because we are saving quite a bit of money, but we are still living the same exact retirement lifestyle. We're still spending the same dollar amount. And a strategy like this, where we are saving $30,000 a year in premiums and taxes, could absolutely be the difference between an early retirement or having to wait until we're Medicare age to retire. So it's super important that we are intentional when it comes to these aspects of our plan. Now, let's talk about this last piece of the tax plan, which is Roth conversions. If we think back to that insurance premium calculation, that was for a silver plan, in which case we may be very healthy, we may not need to go to the doctor all that much, and we may be comfortable with a bronze plan, which would cost even less. And at that income level, may even be a $0 premium plan. We may actually get that coverage for free. And in which case, if we run an analysis, run the evaluation, we can think about, well, maybe I want to do small Roth conversions now at a lower tax bracket, so that, and this is essentially going to be 0% bracket if we are thinking about doing a $30,000 Roth conversion, netting it out with the standard deduction, and then still having income above and beyond at the 0% capital gains rate. So we can work all that out. It can be very, very valuable. But because our health insurance premiums are calculated at modified adjusted gross income rates, not our taxable income levels, we might have to pay a little bit in health insurance premiums then. And so we can evaluate, is it worthwhile paying a couple $100 a month in health insurance premiums to then do these Roth conversions to minimize the impact of those pre-tax IRA withdrawals later on in life? Now, even if we hit pause on our Roth conversions today until we're Medicare age, once Frank and Monica are both on Medicare, I would really want to turn up the dial on our Roth conversion amounts, because we're going to have to start thinking about Medicare IRMA, which is increased cost of Medicare Part B and Part D premiums based on income, and the impact of RMDs at their age 73 or 75. So it's not that Roth conversions shouldn't be done now, We just need to be really intentional about the trade-off. And if the tax implications of those RMDs and where that's going to bring us for IRMA later on would negate the benefit of keep our income super low now, we may want to find some balance here today. Otherwise, it might not make sense to do any Roth conversions here with Frank and Monica until they're both on Medicare. And now we could turn up the dial to prevent the penalties or to prevent the significance of RMDs and their tax situation later on in the future. And so that's probably a calculation and a case study video for another day. But for today, I really hope this was valuable. And for more content just like this, check out my channel. Thanks for watching.